Welcome back, Alpha Hunters. In this video, I will be covering two option Greeks, delta and gamma. First, I will start by defining what these terms mean, why they are important, and how they work together. Then, show some examples of charting and how to find this information in your broker. See you on the green side. So the great Greek gods of relationship change and the rate of relationship change are here to cast down upon thee. Okay, maybe not those kinds of Greeks and their mythology, but the option Greeks hold great power over how options change in value. The two that I'm covering today are more closely related than the others. That is why I'm covering delta and gamma together. One very important factor to know about the option you choose to trade is how fast does it change in value when the stock changes in value. This is the basic idea for delta. The delta value shows you how much the option will change in value with a 1-point increase in the stock price. Delta is limited to be between 0 and 1 for calls and 0 and -1 for puts. Typically, at-the-money calls will have a delta of 0.5 and puts will have a delta of -0.5. Delta for in-the-money calls will typically be between 0.5 to 1, and puts will typically be between -0.5 to -1. Out of the money calls will typically be between 0 to 0.5, and puts will be between 0 to -0.5. And if you were to chart delta for all strikes in a given expiration period, it will look like an S-curve chart. I'll show you that in the broker a little later in the video. But this is another way you can look at delta and the ranges that it has. Okay? So as we see right here in the middle, this is the stock price, or whatever the stock price it is at the money for your calls and puts. So your call will typically be around 0.5 for at the money. Your puts will be -0.5, okay? And then as you go below the stock price, the strikes that are below the stock price, they will be in the money for calls, and they will range between 1 to 0.5. And then puts, these will be out of the money, so they will range between 0 to -0.5. And then as you go to strikes above the stock price, calls, they will obviously be out of the money, so they will range between 0.5 to 0. And then puts, they will be in the money, so they will range from -0.5 to -1. Now, the reason why puts are negative, I mentioned a little bit earlier, but I just want to make sure that you understand this, as is very important, is because it is a calculation based on a 1-point increase in the stock price. So don't forget that on when you're talking about puts. As when you see this in your options chain and you're looking at option pricing and option statistics, that will be very important, so do not forget that. So feel free to screenshot this. Gamma, you don't hear about as much, but it is still around, so if you see it, you will now know what it is. Gamma is the increase to delta for a 1-point increase to the stock price. Charted, it looks like a bell curve across an expiration date, with the at-the-money strike being the peak. Why you usually don't hear about gamma is it's typically used in larger portfolios like hedge funds. So for most typical retail traders, it's not nearly as important. The analogy that is generally used when explaining delta and gamma for an options change in value per the stock change in value is delta is like velocity or speed, and gamma is like acceleration. Now give me 1 second, I'll switch over to the broker, and I'll be right back. So here we are, 1 second later, like I promised. Maybe it was 2 seconds. Now, this is the delta chart for calls. Like I said, it's kind of like an S-curve, okay? Now, I know up here, when you get like super in the money with these calls, it's like, why does it just jump to 100%? It's basically just the market. They kind of just give up and say, hey, I'm just going to give you 100% delta. is kind of what that is. So don't worry really too much about that because you're not going to be using options up in that area. Strike prices up in deep in the money, most likely. So each one of these lines represents an expiration date. Okay, and when they get to this middle point, they then all flip around. Okay, so the line that's on top here is then now below over here. Okay, it's more smooth. There's more time for it to kind of work out, so that's why it's smoother. Now, as you get near term, when you get to like the nearest expiration, it's right here, this teal line. So let's turn them all off, and I'll show you that teal line and what it looks like. No, now it's purple, so it changed on me. So sorry about that if that's confusing. But here's this purple line. It's just like an S curve, but it's extreme because there's not much time left for the stock to move in either way to really impact delta that much. So that is what delta looks like for call options. Okay, so here's what it looks like for put options. So for put option delta. So it's nearly the same for as the call options. The big difference is over here, the put option delta, you'll see these are negative numbers, right? Okay, so I'll flip it over if you didn't notice that earlier. So these are positive, and as you flip over to puts, these are negative. So this is what delta looks like. So let's look at gamma real quick. And gamma, like I said, is just a bell curve, right? With at the money being the extreme kind of peaks on the near term. Now, one thing that's kind of interesting to note about gamma is the peak for out of the money, like farther out of money in time, is actually kind of it's out of the money, but it's out of the money by a good amount, and it like the peak gradually works its way to being where the current stock price is. So it's just kind of one of those weird things, but the peak is for near-term options is generally is at the money. Nothing real shocking, okay, here. And then we'll look at it for puts, and it should be darn near identical, and yeah, it's pretty much identical. Now I'm going to throw up both of these charts for just calls. So I'll put a delta up top, and I'll put gamma on down below. And what you see is all the noise is here at the money. That's where all the noise is. This is where most people do their trading. Okay? Trying to exploit market prices and stuff like that. There's a lot of activity here for delta, gamma, and the other two Greeks that aren't covered in this video, which are theta and vega. Okay, so let me go quickly over to an options chain, and let's look at an option and change this to delta, gamma, theta, vega. And what we will notice is right here, this column for call options is delta. This column is gamma. Don't worry about theta and vega for this video. And then over here, you'll notice that delta is negative. So I mentioned that earlier. So delta is negative, and the delta for call options, as you go, want to make sure you watch the strike prices as you go up on the screen. The strike prices are actually going down. So they're becoming more in the money for call options, which the delta then is increasing. Okay, and the option price, the bid ask here on the option price, they're increasing. Okay, now flip that for puts. You go higher on the screen, the strike goes lower, which then for puts they get less expensive, and then the delta actually becomes higher in this case. So some ways that you kind of maybe want to use delta, like I hear a lot of people talk about, like, you want like a 0.7 delta, 0.8 delta. It kind of depends, because when you get up into the end of the money stuff, even though you're using like a 0.7, 0.8 delta or whatever, the problem that becomes is your risk to reward is a lot less, right? So if I just took 70 cents and let's say I divided by 16. Open up the calculator real quick. So 0.7 and divided by 16. So that delta makes up 4% of that options price, right? But if you come down here to like more a little bit out of the money, and we'll say this one right here, this is 31 cents, and it's currently trading at like 310 to 316. So we'll just call it 315. So what was it? 0.31 divided by 3.15. Enter. So that makes up almost 10% of the option value. So for a 1 point increase, this option would see a 10% increase in its value. Okay, that is basic. Or I'm sorry, this December 15, 2021, 462 call. That would see a roughly 10% increase in value if the SPY, that's what the option, the stock that we're looking at, if it went up in value by 1 point. Okay, so, and it's like that. You can do that kind of analysis on the put side as well. But I just want you to be aware, like, there's no right or wrong. It just depends on how you're choosing to implement, whatever strategies you're wanting to do. There's no right or wrong way on how you go about doing stuff. It's just about implementation. If you want a little bit more of a breakdown on options pricing, click the video in the top left. Alrighty, take care, Alpha Hunters.